You did not buy BBAI because you enjoy reading accounting standards. You bought it because defense AI sounds like a moat, U.S. national security relevance, long-lived missions, and budgets that do not vanish overnight. Then the stock teaches you what markets actually price, revenue visibility, reporting credibility, and the unforgiving timing mechanics of federal procurement. BigBear.ai Holdings Inc., traded on the New York Stock Exchange, sits in the U.S. defense-adjacent ecosystem, yet it has repeatedly traded like a referendum on unanswered questions. The central mystery is fundamental. Why does a government-facing, mission-critical AI contractor still struggle to deliver predictable, underwritable performance? BigBear.ai positions itself as a decision intelligence provider, AI-enabled analytics and operational support for complex, regulated missions. The mistake many investors make is modeling this like commercial SaaS. Federal contracting has different revenue physics. The normal chain is requirements are defined, funding is authorized, a procurement vehicle is selected, an award is announced, then revenue depends on execution, task orders, obligated funding, milestones, testing, acceptance, invoicing, and payment. A contract headline can arrive early, recognized revenue can lag. That timing gap is why award is not visibility and why stocks like this can swing when investor imagination outruns procurement reality. The credibility cloud that shaped 2025 traces back to December 2021, when BigBear.ai issued convertible notes due 2026. In a normal case, investors worry about leverage, the 2026 maturity, and dilution risk if conversion occurs. What is less normal and more damaging is when embedded features of the instrument require complex accounting treatment that later forces restatement of prior financial statements. That scenario surfaced publicly in 2025. Between March 18 and March 25, 2025, BigBear.ai's 2024 Form 10-K included restatements affecting prior periods tied to the conclusion that the conversion option in the 2026 notes required derivative bifurcation under ASC 815 and fair value measurement. In plain terms, part of the instrument had to be treated like a derivative and remeasured, and earlier reporting was revised. Whether or not this altered cash flows, the market effect is consistent. Restatements destabilize baseline numbers and widen the uncertainty band around future reporting. The credibility hit deepened because the company also disclosed a material weakness in internal control over financial reporting. Normally, internal controls reduce the risk that material errors reach published financials through reconciliation, review, documentation, and approvals. A material weakness means there is a reasonable possibility that a material misstatement would not be prevented or detected on a timely basis. Markets translate that into a credibility tax. Discount rates rise, valuation multiples compress, and even legitimate operational progress is undercredited until clean reporting is demonstrated across multiple cycles. In April 2025, another overhang arrived. A securities class action was filed on April 11th, 2025, asserting a class period from March 30 for 2022 through March 25th, 2025, with notices circulating widely. The normal U.S. pattern after restatements or major adverse disclosures is that plaintiff firms file class actions alleging misstatements or omissions. Timelines can be long and outcomes vary. Regardless of outcome, litigation adds friction, management attention, reputational drag, and negative narratives that persist longer than a single quarter. Now layer that credibility cloud onto a defense AI validation headline that should have strengthened the thesis. On February 5th, 2025, BigBear.ai announced a Department of Defense-related contract involving the Chief Digital and Artificial Intelligence Office tied to enhancing a VANE prototype effort. In the normal market script, this reads as validation, relevance to defense modernization priorities, and potential follow-on work. But federal procurement reality is slower than investor imagination. Prototype efforts can remain narrow, scaling depends on budgets, program decisions, and procurement pathways that can shift. Validation does not automatically become predictable revenue conversion. That tension is why August 2025 became a fundamental inflection. BigBear.ai revised 2025 revenue expectations down to roughly $125 million to $140 million amid federal contract uncertainty widely reported as including U.S. Army-related uncertainty. Timing issues are normal in government contracting. What is less normal and what investors find mysterious is a full-year reset large enough to change revenue expectations after momentum headlines. When full-year guidance shifts materially, markets assume the uncertainty is not just quarterly noise. Because investors cannot observe every operational mechanism, they form hypotheses. One is concentration risk. Reliance on a narrow set of programs or agencies makes guidance fragile. Another is procurement vehicle transition risk. The mission remains, but contracting mechanisms change, recompetes, modifications, or funding timing, creating a revenue air pocket. A third is performance and acceptance timing. Revenue recognition can slip if deliverables or acceptance milestones move, implying the business remains integration heavy rather than product-like recurring. Any one hypothesis might be wrong, but the fact that multiple are plausible is exactly why the market discounts the equity. Unmodelable uncertainty becomes a valuation haircut. In November 2025, BigBear.ai tried to change what it is being priced for by announcing a definitive agreement to acquire Ask Sage for about $250 million. Ask Sage was positioned as a generative AI platform built for defense and highly regulated environments, with estimated 2025 annual recurring revenue around $25 million. Strategically, the logic is straightforward. Add a recurring revenue engine to improve predictability and reduce dependence on lumpy procurement timing. ARR, annual recurring revenue, is an investor metric approximating annualized subscription revenue. If retention is strong, ARR can imply repeatability and support higher valuation multiples. But the timing creates a second mystery. Normally, after a restatement and a disclosed material weakness, companies prioritize remediation and stability, clean reporting, improved controls, steadier guidance, before taking on a large integration effort. Pursuing a major acquisition while credibility is being repaired and while federal uncertainty already pressured guidance yields dual interpretations. Optimists see a proactive pivot into regulated generative AI that could improve visibility. Skeptics see a narrative patch meant to outrun distrust. Until integration results show up in reported performance, the market cannot choose, so it prices ambiguity. Technically, BBAI has behaved like a high beta, catalyst-driven asset. It has traded across a wide 52-week range, roughly low 2s to low 10s, reflecting repeated re-rating between an AI premium regime and an uncertainty discount regime. Volatility has been notable, with ATR around 0.6 and recent Bollinger Ranges spanning roughly low 5s to high 6s. RSI around the high 40s to about 50 suggests neutral momentum, typical when direction depends on fundamental resolution rather than a stable trend. Moving average context places a medium-term conditioning zone near the high 6s around the 50-day area, and a longer-term battleground in the mid-5s to low 6s around the 200-day band, depending on source. A disciplined investor framework is 2 engines with 3 risks. Engine 1 is government mission relevance. If procurement visibility stabilizes and guidance becomes more reliable, the market can re-rate upward. Engine 2 is Ask Sage. If integration succeeds and recurring revenue proves durable, predictability can improve. The risks are procurement timing uncertainty, integration execution risk, and the credibility tax from restatement and internal control weakness. That framework supports actionable positioning. Short-term, a tactical support zone has existed around roughly 5.20 to 5.30. A sustained break below roughly 5.10 increases downside risk. Near-term resistance has sat around roughly 6.90 without fresh catalysts. Medium-term, sustained acceptance above roughly 680 improves odds of testing the 7 area. Failure to hold above that zone and drifting toward the contested 200-day band suggests continued uncertainty pricing. Long-term, like a durable move toward the low 10s, becomes plausible only if the company repeatedly demonstrates stable guidance, credible control remediation, and measurable recurring revenue contribution from Ask Sage. Without that proof, lower regimes historically, including the low 2s, remain possible. Now, if you are following this kind of messy story and you have a ticker that you think belongs on ValueStir, drop it in the comments. We are taking tips from listeners on public stocks, private companies that are getting close to going public, and coin projects that you believe have a real narrative worth investigating. Tell us the symbol or the name, and tell us the one reason you think it matters. One line is enough, we will do the digging. And if you have been watching, subscribing, liking, commenting, and sharing these episodes outside this channel, thank you. That kind of support is how we justify going deeper, and we will repay it with stronger research and better stories. The central mystery remains: can BigBear.ai convert defense validation into predictable, auditable economics while repairing credibility and integrating a regulated generative AI platform? Investors do not fear complexity, they fear complexity they cannot model. Until the company answers with repeatable numbers, the stock will keep trading like uncertainty is the product. This was Value Stir.